Okay, so you want to own a bank. Not a savings account, not a small loan business. A bank, the kind of institution that holds the life savings of thousands of families, approves mortgages on houses, and keeps the entire local economy running. But here's the strange part. The person who owns the bank almost never touches the money. Tellers do. Loan officers do. Computers do. The owner just sits at the top, collecting a tiny sliver, sometimes less than 1%, of every dollar that flows through the building. By the end of this video, you'll know exactly how much it costs to open a bank, how the money actually moves through one, and why dozens of small banks quietly disappear every single year. Let's get into it. First, what exactly are we talking about? A bank is a business that does one simple thing. It borrows money cheap and lends it out expensive. That's the entire model. The marble lobbies, the ATMs, the mobile apps, all of that exists just to make that one trade happen at scale. In the United States alone, there are roughly 4,500 banks and credit unions, managing a combined $23 trillion in assets. That's larger than the entire economy of the European Union. Most people picture giants like JP Morgan or Bank of America. But the vast majority of banks in America aren't giants at all. They're small community banks, often run out of a single building in a town of 10,000 people, with maybe 20 employees total. Here's the surprising part. The number of banks in America has been shrinking for 40 straight years. In 1984, there were over 18,000 banks. Today, fewer than 4,500. But we're not here for a history lesson. We're here to find out what it actually costs to open one and why so many of them eventually close. To open a bank from scratch, what regulators call a novo bank, here's what you're looking at. Regulators typically require somewhere between $12 and $30 million in starting capital, depending on the size of the bank you're planning. A small community bank might start around $12 million. A mid-sized regional startup, closer to $25 million. A larger regional ambition, $50 million or more. But raising that capital is the easy part. Before you issue a single loan, you need a federal or state bank charter, and the application alone can run over 1,000 pages and take 12 to 18 months to get approved. You need separate approval for FDIC deposit insurance. You need a board of directors with banking experience that regulators actually trust. You need core banking software and infrastructure, which typically costs $500,000 to $2 million just to get the systems running. And you need a physical headquarters that meets banking security standards. Add it all up, and a realistic bank launch costs $15 to $35 million before you've made a single dollar in loans. And here's the part that surprises people. Roughly 80% of that initial capital just sits there as a regulatory cushion. You can't lend most of it out. It exists purely so regulators believe you can survive a bad year. Once you own the bank, the bills start immediately. Compliance and regulatory staff cost $300,000 to $1 million a year. Staffing for 20 to 40 employees runs $2 to $4 million a year in salaries and benefits. Technology, online banking platforms, cybersecurity, and fraud detection cost another $500,000 to $1.5 million annually. And that number keeps climbing every year. Total annual operating cost for a small bank lands somewhere between $4 and $7 million. And that's before a single loan defaults. Now here's where it gets interesting. A bank makes money in three main ways. The first is net interest income. The bank pays you maybe 1% on your savings account, then lends that same money out as a mortgage at 7%. That 6% spread, multiplied across billions of dollars in deposits, is where most of the money comes from. The second is fees. Overdraft fees, account maintenance fees, wire transfer fees. The third, and this surprises people, is interchange income. Every time someone swipes a debit card issued by your bank, you collect a small percentage of that transaction, almost passively. For a small community bank with about $1 billion in assets, annual revenue typically falls between $35 and $50 million, with profit margins sitting around 1 to 1.5%. Compare that to the stock market's average return of around 10% a year for investors. Banking is a volume game. Thin margins, enormous scale. But here's the catch. That 1% margin can disappear completely if even a small percentage of loans go bad. A profit margin of just over 1% can be wiped out entirely by a default rate increase of half a percentage point. There's almost no cushion. So with all this revenue potential, why do banks fail so often? The first mistake is concentration risk. Silicon Valley Bank put an enormous share of its deposits into long-term government bonds. When interest rates rose sharply in 2022 and 2023, those bonds lost value fast. When depositors got nervous and tried to withdraw all at once, the bank couldn't cover it, and it collapsed in 2023, one of the largest bank failures in American history. The second mistake is loan concentration. Many small community banks fail because they lend heavily into one industry, often commercial real estate in a single city. When that one sector crashes, the bank's entire loan book crashes with it. The third mistake is underestimating a bank run. Once depositors lose confidence, withdrawals can outpace any bank's cash reserves within hours, not months. These three mistakes show up again and again. Concentration, mismatched risk, and underestimating how fast confidence can disappear. So, should you own a bank? Let's recap the numbers. Startup investment, $15 to $35 million. Annual operating costs, $4 to $7 million. Annual revenue for a small bank, $35 to $50 million. Profit margin, roughly 1 to 1.5%. Payback period for a new community bank to become consistently profitable, typically 8 to 12 years. My verdict, owning a bank isn't really an investment in the traditional sense. It's closer to running a heavily regulated utility with razor-thin margins, where your real product is trust. The people who succeed at it aren't chasing high returns. They're building something that compounds slowly, often passed down through generations in the same small town, but that's the economics of owning a bank. From $15 to $35 million to open the doors to a profit margin so thin that half a percentage point of bad loans can wipe it out entirely. But for those who survive the first decade, a bank can become one of the most stable, recession-resilient businesses in the world. Subscribe. Next week, we're breaking down the economics of owning a cargo ship. The numbers on that one are even more surprising than you think.